Okay, let's just dive right into this explainer. Today, we're demystifying the stock market, and we're doing it by borrowing the brain of the Oracle of Omaha himself, Warren Buffett. Look, if you're a complete beginner, Wall Street probably looks like a totally foreign language, right? Like it's literally designed to confuse you. But we're going to break down Buffett's surprisingly simple and honestly incredibly effective principles that anyone can use to actually build wealth. So here's our agenda for today. We've got 1, the Oracle's ultimate secret; 2, the $1,000,000 bet; 3, 3 rules of investing; 4, Buffett's do's and don'ts; and finally, number 5, wealth and true happiness. All right, kicking things off with section 1, the Oracle's ultimate secret, demystifying Wall Street. So here's the thing we got to address right up front. Buffett is a professional. I mean, the guy literally spends most of his day reading books, newspapers, and, these massive annual reports. He does this to build up this huge cumulative knowledge over decades. But let's be real. He knows most of us don't have the time or, honestly, the desire to do that. So the big question is, what does the most successful investor on the planet actually recommend for the average person who just wants to build wealth but doesn't have a fancy finance degree? Well, the ultimate secret is actually shockingly simple: low-cost index funds. That's it. His advice for the vast majority of people is to just make regular, consistent contributions to a low-cost stock index fund over a really long period of time. You're not trying to dump all your money in at once, you just consistently invest over the years. Because basically, you're just placing a bet that American business as a whole will do well over time, even if you don't know nearly enough to pick specific winners or perfectly time the market. And, this quote brilliantly illustrates why you almost never hear this advice on those flashy financial news networks. As Buffett points out, nobody gets paid a massive fee to tell you to just buy an index fund and sit on your rear end. It's so true. Wall Street pros are heavily incentivized to sell you these complex, actively managed products because, well, that's what generates high fees for them, not necessarily high returns for you. Which brings us right to section 2, the $1,000,000 bet, proof that simple wins. Okay, so back in 2007, Buffett actually wanted to prove this point to the entire world. So he made a massive 10-year charity bet. He essentially pitted a boring, simple, low-cost Vanguard S&P 500 index fund right up against a basket of hand-picked, highly paid hedge funds run by top-tier Wall Street professionals. It was literally the ultimate showdown: low-cost passive investing versus super expensive active management. And man, at the end of that 10-year wager, the results were just staggering. The simple S&P index fund gained an incredible 125.8%. It absolutely crushed the hedge funds, which, by the way, only managed an average gain of about 36%. I mean, this is hard, undeniable data, proving that you do not need complex algorithms or wildly expensive advisors to win. Simple consistency usually takes the prize.
Now moving on to section 3, 3 rules of investing, the DIY toolkit.
So if you decide you actually do want to pick individual stocks yourself, Buffett relies on a bedrock philosophy from Benjamin Graham's classic book, The Intelligent Investor. And rule number 1, stop treating a stock like it's just a blinking ticker symbol on your phone. Instead, you've got to evaluate it as an actual slice of a company's future profits. And to do that, Buffett uses 4 strict criteria. 1, a business we can understand. 2, favorable long-term prospects. 3, operated by honest and competent people. And 4, available at a very attractive price. To really explain that second point, the favorable long-term prospects, Buffett uses this amazing analogy. He says, every business that we look at, we think of as an economic castle. And in capitalism, millions of people are out there constantly trying to take your castle away. So you have to ask, what kind of a moat do you have around that castle that protects it? That moat could be super low prices, proprietary tech, or even just a massive established brand like Coca-Cola that literally keeps competitors at bay. Okay, this second rule relies on understanding the stock market itself. Graham and Buffett love to use this concept of Mr. Market. Think of Mr. Market as this obliging imaginary business partner who shows up every single day to offer you a different price to either buy your share or sell you his. The absolutely crucial takeaway here is that the market is there to serve you, not to instruct you. And here's where Buffett gets kind of funny with it. He says, this partner of yours is a heavy-drinking manic depressive. When Mr. Market gets panicked, prices just plummet.
But instead of freaking out and selling, Buffett views that crazy volatility as a total gift. It's literally just Mr. Market giving you a chance to buy great businesses on sale. As Buffett puts it, if you walk into a McDonald's and suddenly hamburgers are half price, you don't panic. You're thrilled because, hey, you're going to be buying hamburgers for a long time. He heavily stresses emotional discipline here. Just think about it. If you bought a farm, you wouldn't wake up and demand a price quote the next day, right? You judge your success by the actual production, how many bushels of soybeans or corn the farm actually yields over time. Yet with stocks, people get so obsessive. They check the daily quote constantly and act purely on emotional fear. Listen, if you buy a good business, check its production, not the daily ticker price. And that leads us to principle 3. Maintain a margin of safety. Look, investing is not Olympic diving, okay? There's no degree of difficulty multiplier here. You literally do not get extra points for pulling off some complex, super risky investment. You get paid just as well for the easy ones. So look for those 1-foot bars you can easily step right over, rather than trying to clear a 7-foot bar. All right, let's hit section 4, Buffett's do's and don'ts, the guardrails.
I absolutely love this quote. The trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. This baseball analogy is just perfect. For his first big do, stay strictly within your circle of competence. In investing, there are no called strikes. You don't have to swing at everything. Just patiently wait for the perfect pitch, a company you fully understand at the right price, and completely tune out the crowd yelling at you to swing.
So, breaking down his core behaviors. The do's are pretty straightforward. Patiently buy and hold, like mostly forever, grab big opportunities when it's raining gold, and purposely go against the fearful crowd. But the don'ts are just as critical. Do not borrow money to buy stocks. That's buying on margin. Do not short stocks because your potential losses are literally unlimited. And please do not try to time the bottom of the market.
Let's actually zoom in on avoiding non-productive assets. Why does Buffett famously stay away from things like gold and crypto? Well, because they're non-productive. Unlike a farm that grows food or a business that sells products, gold and crypto just sit there. They cannot produce anything or multiply. When you buy them, you aren't really investing in production, you're just making a speculative bet that somebody else is going to come along and pay you more for it later.
Okay, finally, section 5, wealth and true happiness, the real bottom line. Buffett offers this really profound warning that I think we all need to hear. You will not be way happier if you double your net worth. He argues that it's completely insane to risk what you already have and what you actually need just to get something you don't even need. Chasing that double net worth through risky bets might give you a temporary rush, but look, if you have $100,000 and you're miserable, $1 million is absolutely not going to fix that. Because at the end of the day, true happiness is not hiding in a stock chart. According to the Oracle of Omaha, it's found in unconditional love and in waking up every single day to do something you genuinely, truly enjoy. He looks at his daily routine of reading and evaluating businesses as simply playing in his playground. So, I'm going to leave you with this final thought before you make your next investment decision, or really your next life decision. Are you making choices out of some desperate need to just blindly double your net worth? Or are you actually building a life where you get to play in your playground? Lean into simple, low-cost index funds to build that wealth slowly and spend your precious time focusing on the things that actually matter.